car insurance premiums in India are set to rise by 10 to 25% in 2026.
India's motor insurance framework could see more changes.
Government may soon overhaul motor third-party insurance rules. A 10 to 20% hike.
10 to 20% hike in third-party premiums.
And if you're trying to reduce your car insurance premiums, that's the last thing you want to hear. Suddenly you start asking the obvious questions. Why does one person pay more on their premiums for the same kind of car while someone else pays less? Is it just the insurer charging randomly, or do factors like the IDV, add-ons, and where you buy the policy quietly change the final number? By the end of this video, you'll know what actually moves your premium and where people often end up overpaying. And if this is the kind of clear explanation on all things insurance that you're looking for, subscribe to Insurance Academy by ACO for more practical insights that help you make the right decision. Now, before we get into the details, it helps to know one thing. This premium number is not at all random. There are few moving parts behind it. And once you see them clearly, the whole thing feels a lot less mysterious. Take two policies for similar cars. For example, if the premium on one ends up cheaper than the other, it's usually not because the insurer is being arbitrary. The difference is often hiding in the structure of the policy itself, the car's value, the cover, or the add-ons chosen, and so on. Here, it helps to compare the two side by side because that makes the difference much easier to see. Once you understand this, you can spot the choices that are pushing your premium higher and avoid paying for things you don't need. So, what's the single biggest factor that affects your car insurance premium? It's IDV, the insured declared value. That's the amount the insurer considers your car to be worth for insurance purposes. In plain terms, it's the value the policy is built around. So if one car is worth 10 lakhs and another is worth, say, 6 lakhs, the first one will usually cost more to insure. Now that part is fairly obvious and straightforward because the insurer is covering a larger amount. But even when the IDV is similar, the premium can still move around quite a bit, and that's where the rest of the picture starts to matter. The car's age, where it's used, how much risk the insurer sees, and which add-ons are included. That is why two policies for similar cars can still end up being priced so differently. So the IDV gives you the starting point, but it doesn't tell you the whole story. Now, the IDV is probably the single biggest factor behind your premium. There are other things that play too, of course, but this is the one that tends to move the number the most. And honestly, it makes sense that people try to bring that number down. The problem is that they don't always think through the trade-offs, which we'll come back to in a bit. But now that we understand what the IDV is, it makes intuitive sense that people will try to lower it, right? If a car is worth 10 lakh and lowering the IDV saves you 800 or 1000 a year, that can look like an easy win, right? But what they might not consider is that if the car is stolen or written off due to floods or whatever, the payout is tied to that lower IDV. So you could end up losing far more than what you had saved. So yes, the premium comes down, but the protection comes down as well. And that's why this one needs a bit more thought than just, hey, can I make it cheaper? And the same idea applies to add-ons. Some of them are useful, but not every add-on deserves to stay just because it sounds like a good idea. A lot depends on how you drive, how often you use the car, and what kind of problems you actually want covered. Now, if saving 800 today means giving up a much larger amount of protection later, that may not be a smart trade. The number on the screen looks nicer, but the policy may not be doing as much for you anymore. So the better question isn't what can I remove? It's what's actually worth keeping, and what only makes sense if it fits the way I drive. What to keep versus what to customize. Now, this is where it gets a little more practical. Now, some add-ons are worth holding on to because they can save you from a much bigger bill later. And one of the clearest examples here is the zero depreciation cover. It sounds heavy, but what does zero depreciation actually mean? It's an add-on that removes depreciation deductions on replaced parts in your own damage claim. Basically, the parts do not depreciate. In plain terms, it helps you get a better claim amount because the insurer doesn't devalue the parts of the car because of wear and tear. So for instance, if your bumper gets damaged in a small accident, having zero dep cover can make a real difference because you're not losing as much on the claim. On a 50,000 bill, the difference between getting most of it covered and losing a chunk of it to depreciation can be a few thousand rupees. And over a bigger repair, that gap can become even more noticeable. So this one makes the most sense if your car is relatively new, you drive in heavy traffic, or you're the kind of person who would rather avoid surprise repair costs. Like, it matters less if the car is older and you're already okay with a lower payout expectation. Then there's engine protection cover. Now this one matters because a basic policy may not fully cover engine or gearbox damage in situations like flooding or water ingress. So if your car goes through deep water and the engine gets damaged, this cover can help with what could otherwise be a very expensive repair. A major engine repair can easily run into tens of thousands of rupees. So this is the kind of cover that can really matter when the wrong thing happens. This usually makes the most sense if you live in a flood-prone area, park in a place that gets waterlogged, or drive often during heavy rains. It matters less if your car is rarely exposed to water risk and you mostly drive in safer and drier conditions. And then there's the no claim bonus, or NCB. It is one of those terms people hear all the time, but not everyone stops to ask what it actually means. So now, what is a no-claim bonus? It's a discount on your own damage premium for claim-free years. Essentially, the no-claim bonus is a discount you earn on your own damage premium for staying claim-free. Now, this one matters more than people sometimes realize because it rewards you for staying claim-free, and that discount can add up nicely when renewal comes around. So that means if your renewal premium is 20,000, even a 20% discount from no-claim bonus can save you rupees 4,000. That's not small, especially if you've been claim-free for a while. Like, this matters most if you've built up claim-free years and plan to keep the car for a while. So if you don't keep claiming for every small thing, the savings stack up over time up to 50%. It matters less if you're already expecting a claim soon or if the discount is still small because you haven't built enough claim-free history yet. Once you've got those core pieces in place, the rest becomes about your driving pattern and how much risk you're comfortable carrying yourself. Now, there's one more thing worth calling out separately: the voluntary deductible. This one works different from the other covers because it's not really about adding protection. It's agreeing to pay a fixed part of the claim yourself, allowing the insurer to charge you a lower premium. Now, this voluntary deductible is one of those choices that can look attractive at first because it brings the premium down. But whether it actually helps depends a lot on how often you expect to make claims. Let me take a simple example. See, I drive to work every day and I choose a higher voluntary deductible of rupees 10,000, and that brings my premium down by 3,000. On paper, that sounds like a good save. But during the year, I end up making 2 small claims and each repair cost me roughly around 5,000. Now, if I had chosen a lower deductible, say rupees 2,000, I would have paid less out of pocket on each claim. Instead, with the higher deductible, my total deductible payments add up to 10,000. So even though I saved 3,000 on premium, I paid a lot more later because I had frequent claims. Now, in my case, the higher voluntary deductible doesn't really help because the savings on premium get eaten up by the extra amount I have to pay when claims happen. So the better way to think about it is this: a voluntary deductible can make sense if you're okay handling small repair costs yourself and you don't expect to claim often. But if you drive a lot or small dents and repairs are likely, then the lower premium may not be worth the extra out-of-pocket cost. Now, there are few other add-ons that are worth mentioning briefly because they're useful in the right situation. Let's get into them. Now, roadside assistance is one of my favorite add-ons because I don't want any stress if my car breaks down. And if the car breaks down, this can help with things like towing, jump starts, flat tire, or getting the vehicle to a workshop. It's the kind of cover that may not matter every day, but when you need it, it saves time and stress. Anti-theft device discounts are another one to watch out for. These usually come with conditions, so it's worth checking whether the device is approved before assuming you'll get the discount. In other words, not every anti-theft device will automatically qualify. And then there's pay as you drive. This one is useful if you don't drive as often because the premium is based more on usage than just a fixed annual assumption. So if the car stays parked for long periods or your odometer doesn't move too much, this can be a smarter fit. But if you drive a lot, the savings may not be as meaningful. The point is simple. These add-ons are not must-haves for everyone. They make sense when they match your actual usage and when the benefit is clearer than the cost. Now that we've looked at the add-ons, the next step is figuring out how to choose the right policy. And that's where buying smart really comes in. See, if you're buying a new car, one thing to keep in mind is that you do not have to take the dealer's or the showroom's insurance policy by default. It is not mandatory at all. That is evidently a very convenient option for the buyer at the showroom, but it may not necessarily be the best one for you. What makes this worth checking carefully is the commission side of the sale. IRDAI linked data has shown that commissions on dealer-linked motor insurance can be significantly higher, with some new private car policies showing commissions in the range of 25% to 57%. That is a big number. And it is exactly why it makes sense to compare before you say yes. For example, on ACO's website, the insurance policy on a car like the Brezza can be priced at roughly 28,000, while the dealer quote may be closer to the 40-50,000 range. A car like Mahindra Scorpio may show a similar pattern with online quotes ranging from 75 to 1,30,000, whereas ACO prices this at around 55,000. That's the advantage of comparing properly online. It helps you see whether a price difference is actually buying you something useful. So the comparison is not just about about saving money. It's about whether the slightly higher premium is worth it for the cover you get. Once you've bought the right policy, the next step is making sure you renew it the right way. That matters just as much as the original purchase. Renew before expiry, ideally at least a month beforehand, so you don't lose continuity. And take a moment to check whether your car's age and usage still justify the same add-ons. Renewing on time is usually cheaper because you avoid lapses, re-inspection hassles, and the risk of losing benefits tied to continuous coverage. It's also helpful to keep in mind that comparing quotes a few weeks before expiry can sometimes get you a better price. Don't just blindly repeat your last year's setup automatically. Your needs may have changed and some covers may no longer be worth keeping. The main idea is simple. Renew on time, review what you actually need, and update the policy instead of copying it blindly. Before we wrap up, here's the final checklist I'd keep in mind. Don't lowball IDV too aggressively just to save some cost. Keep the add-ons that protect you from major losses. Add optional features only if they fit your actual usage. Buy and renew online when possible because it makes comparison easier and helps you make a more informed choice. Always keep in mind that at the end of the day, the best policy is the one that gives you the right protection, the right cover, and real value when you need it most.